Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. China's industrial profits surged in August, suggesting a national campaign to tackle overcapacity and competition is paying off. After years of aversion, global money managers are venturing back into China, with official data showing foreign inflows rising across asset classes. And with foreign funds still underweight on mainland equities, could the rally have more to run? Pepperstone Group's Dilin and AXA investment managers Ecaterina Bigos will be joining us to give their takes. And India beats Pakistan to win cricket's Asia Cup, but then refuses to receive the trophy. We'll look at the geopolitical tensions that led to that. A quick check on the markets. Traders getting their first chance to react to Friday's inline inflation reading out of the U.S. This week's key data point includes Friday's payrolls report, but a potential U.S. government shutdown is threatening its release. Meantime, Chinese stocks are also in focus. Its world-beating stock rally has piqued the interest of global money managers. Goldman Sachs says hedge funds last month were the most active in onshore equities in recent years. Over the weekend, China also reported that industrial profits surged in August after months of declines, signaling that national campaigns to tackle overcapacity and excessive competition are now bearing fruit. Let's bring in our China correspondent, Min Lo. And Min, quite a jump for industrial profits and pretty much quite unexpected.
Yes, we're looking at about 20% or so increase on year, which is quite sizable. But bear in mind that this is partly because of a low base effect, because you look at a year ago in August, we were looking at close to 17% decline. That was what precipitated eventually that stimulus measures that we saw in end September last year. So that helped boosted the numbers this year. At the same time, we are also seeing demand still pretty weak, because if you look at inventory levels, it shows you that the final demand is still weak, especially when it comes to downstream sectors like EVs as well as solar panels. We're still seeing, while industrial profits is increasing, the sales is still down, so that decline in output perhaps offsetting the improvement in the industrial profits. But here you can see on the chart the year-to-date number, 0.9%, which is quite significant, because our Bloomberg economics team was forecasting a decline of 1.6%. So certainly it does show that perhaps the anti-involution campaign has really been seeing some effect here. And especially if you break down the numbers and look at some of the sectors where we are seeing the biggest increase, that's the large equipment manufacturers, especially for shipbuilding, aerospace sectors. And state media is pointing to that as an example of how China is very successful in transforming its economy into a high-tech one, in upgrading in its industrial structure as well.
And Min, we're also getting PMI numbers tomorrow. What's the crystal ball pointing to for the third quarter?
Yeah, PMI numbers not too optimistic. If you look at the official manufacturing PMI, analysts still estimate a contraction at the moment, which will make it the 6th consecutive month of contraction. Non-manufacturing PMI expected to expand, but at a slower pace than the previous month. And our Bloomberg economics team believes that construction is going to be a drag, partly because perhaps the government support when it comes to infrastructure investment could be slowing down as we look towards the end of the year. At the same time, property sector continues to be a drag. You look at inventory levels of steel rebar continues to remain high. But yes, we have the Golden Week coming up next week, and that could help lift some of the consumption or spending numbers that we'll be seeing that could be reflected in the PMI tomorrow as well.
As you said, Min, China's Golden Week coming up in just a couple of days. All eyes on consumption over the holiday period. What really can be expected?
Yes, we are expecting pretty robust numbers because this year's Golden Week is 1 day longer. It's an 8-day holiday instead of 7 days because it coincides with the Mid-Autumn Festival. So we expect more people to travel for longer. So the government, the Ministry of Transport, has forecasted about 2.37 billion trips to be made during this Golden Week holiday. And preliminary numbers from some tour operators, for example, they're looking at 130% increase in holiday bookings already in early September. So quite good numbers there, but some analysts are cautioning that the number that we really want to look out for is the per capita spending, because we want to see whether that consumption downgrading theme is still in place. Are people traveling more but spending less? So that's something to look out for. Box office numbers also something to look out for because there are 11 films coming out during Golden Week, so it's well positioned to capture any tailwind from that holiday.
And that's going to keep you busy, Min. Bloomberg China correspondent Min Lo in Hong Kong. Thank you so much for that. Let's get market insights from our panel of guests. Dilin Wu is research strategist at Pepperstone Group, and Ecaterina Bigos is CIO Co-Investment Asia ex-Japan at AXA Investment Managers. Ecaterina, let's start with you. From what we hear from Min, data out of China has been pretty mixed. But when you take a look at the markets, Chinese markets have been on fire. How do you square that?
Yeah, I think there is certainly observing a decoupling of the macro from the markets, and this is not unusual. It hasn't happened just in China. And I think it's fair to say for China itself, I think the narrative has shifted. We had various events that shifted the narrative. First, we had the breakthrough in technology, which is artificial intelligence, with DeepSeek at the beginning of the year. We also had biotech, which has been a strong supporter of that rally. And last but not least, we've heard the correspondent from Bloomberg mentioning the anti-involution efforts, which has led to earnings recovery, but also the multiple have rallied on our expectations that those earnings will continue to deliver. Now, all in all, if you look at the macro picture, the structural challenges, the macro challenges that China has faced are still in place. Now, we can still see that decoupling continue because partly it was driven as well by the liquidity that's come into the market, coming out of savings, coming out of money markets, and coming out of fixed income, which has shown quite a fair amount of volatility this year. And certainly the appeal now for equities increasing with that re-rating that we've seen, higher dividends, and certainly the expectations of potential earnings recovery into the year end.
So, Dilin, by the same token, there is momentum, and you have to ride it or you lose out. Even we have, of course, Cathy Wood getting into the Chinese market for the first time in 4 years.
Well, actually, I'm personally quite optimistic about China and Hong Kong market. I mean, stocks are supported by both policy tailwinds and also the push for domestic AI chip substitution kind of story. And the broader AI theme is gaining momentum, especially as it becomes a national strategic priority. Established names like Alibaba, Tencent, and Baidu are performing well, while new players like Cambrican are drawing attention too. So overall, I would be bullish on China and Hong Kong equities among Asian market. For China, I think we're currently at a bad news is a good news phase. I mean, weak economic data could prompt stronger policy stimulus, creating buying opportunity, as also tariff pauses help stabilize the market sentiment. So while I would be quite optimistic about the market, and I think international capital investment to China is basically the upcoming momentum in the following months.
So, Dilin, it is about strategic diversification as well, right? Because the U.S. assets are getting just way too crowded.
Yes, indeed. And actually, many of my clients and traders are asking me whether Chinese companies like Cambrican and many of the big names can realistically rival NVIDIA or even Nasdaq 100, substituted by CN50 and the Hang Seng Index. My answer actually would be cautiously optimistic, because domestically developed chips are making steady progress for sure, but significant gaps remain in terms of performance, energy efficiency, and also ecosystem maturity. And R&D investment requirements are immense. And while government support is substantial, it cannot instantly close the gap with established leaders like NVIDIA. And additionally, the broader supply chain, particularly high-end manufacturing and packaging capabilities, heavily relies on partners such as TSMC. So in my view, while Chinese kind of AI chip makers will gradually close the performance gap and carve out niches in certain applications, they are not yet in a position to directly challenge NVIDIA or to, substitute or replace the position of Nasdaq.
So, Ecaterina, no threat of getting burnt by Chinese policymakers, right? Because after all, it's become a strategic policy. It is of national interest. So when you talk about, tech in China, that's you have to keep chasing it.
Yeah, to a certain degree. I mean, clearly this has become strategic, and I think this is the shape of the AI story to China and globally has become center focus to investors in terms of capital deployment, in terms of direction of flows. But also we have to be cognizant, of course, that applications yet of AI have not materialized. And we're going to see periods of volatility until we get through the stage of development, which we are at that stage of development, the investment, the capex that's been put in place. The applications have not materialized. And any signs that this is being delayed or any signs that this is not materialized to the expectations of investors will bring some level of volatility. The markets are concentrated. They're concentrated in US. We know that the tech has been leading, again, similar to 2022, 2023, 2024, has been leading that rally. And we need to be cognizant as well of kind of those valuations and the volatility. Again, not that the theme is not present, but the volatility will be certainly an element that investors need to tolerate going forward.
And not to say, Ecaterina, there are no risks. I mean, there are massive risks out there when you trade in the Chinese market. Front and center, of course, trade negotiations between the U.S. and China. And who knows where tariffs will land? How do you hedge against such risks?
No, ultimately, as I said on various sessions that we had with you, it's China. It has its own narrative, its own China story, and ultimately, what China needs to press with is to revive that domestic consumption. And again, over these holidays, the upcoming holidays, a lot of attention will be: is this happening? Is this materializing? Has China done sufficient amount of support to the consumers, to the household, to revive that sentiment? And ultimately, that's what is going to weather China through this period of volatility, the uncertainty around tariffs, the uncertainty of potential strategic sectors being subject to some tariffs going forward. Ultimately, that China is shaping its own narrative, as I said, and that narrative staying intact is very much dependent on that consumer kind of reviving and continue to drive some of that growth increasingly from here onwards.
Dilin, it is interesting that we're talking about a Chinese market that is on fire. If you take a look at the Shanghai Composite Index, it is at the highest level in 10 years. But when you take a look at the levels, it is at the same levels as August 2015. So effectively, it's gone nowhere. Is that a right way to look at it?
Well, I think the market participants are still finding their way to pricing the upcoming stimulus. And actually, I find the Central Economic Work Conference by the end of this year, basically early December, could be quite critical because from the fundamental perspective, the profit rebound and potentially improving PMI could be encouraging, but we can't ignore some of the structural challenges and external pressures from the U.S. tariff, for example. The bigger question is how the economy performs after the Golden Week, and also whether policy support can actually translate into substantial growth. And because the tariff pause between U.S. and China would be in November the 9th. So after this, the end of year conference would be quite critical observation windows for us to look into.
Dilin, what do you make of retail participation in the Chinese market? If you take a look at the report by HSBC, it talked about how Chinese investors account for 90% of the daily trading volume versus the U.S., which is at 20%. How much risks are there when you take a look at such numbers?
Well, I think I do see some of the potential risks because market is still quite cautious about trading into this current market, especially we don't know how we expect the following stimulus, such as lower the LPRs, etc. So I would say people need to locate their capital into some of the markets, and because we are trading at the very top right corner of the Nasdaq and in the US equity markets in general. So they will think about parking their capital into Chinese or Japanese equity market. So I think after we got more clarification, especially we observed the activity data in October after the Golden Week, then we can see more broader markets growing in the next couple of weeks.
Ecaterina, could this boom tend to bust rapidly?
Well, again, ultimately, the macro needs to deliver at some point. We are in deflation, or China is in deflation. It needs to get out of deflation for the broader market or the earnings in the broader market to recover. As I said earlier, there are certain pockets of the market that have delivered because of the innovation, because of the stimulus that we had from policymakers. But the broader market has not recovered yet, and depends on that revival and deflation, getting out of deflation, ultimately, as I say, anchored around consumer confidence is anchored around employment, the risk around employment and property market. And we know all of those has been reiterated many times and still stay the case. Again, there is a momentum there in China. There is an excitement, but we need to be cognizant. But for a broader and more sustained rally in China, we need to see that deflation kind of emerge, or economy emerging out of deflation.
That's right. The question is for how long. Dilin Wu of Pepperstone Group and Ecaterina Bigos of AXA Investment Management are sticking around. When we come back, we'll take a closer look at the AI rally and why strategists believe the Magnificent Seven is starting to look a tad dated. More on that next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Wall Street's most powerful collection of stocks, the Magnificent Seven, is looking a little dated. Analysts suggest that investment strategies based on the septet are missing some firms that are also expected to thrive in an AI future, like Broadcom, Oracle and Palantir. That's because the AI trade has expanded in unexpected ways and moved beyond several of the market's favorite big tech companies. Strategists are now proposing variations to the Mag 7 to capture the real winners of the AI trade, including the Fab 4 of NVIDIA, Microsoft, Meta, and Amazon. Dilin Wu, research strategist at Pepperstone Group, and Ecaterina Bigos, CIO Co-Investment Asia ex-Japan at AXA Investment Managers, are still with us. Dilin, let's start with you. You say the trend is your friend until it's not.
Actually, I still believe the trend is still our friend. And looking at the market performance over the past 2 years in the US equity markets, if it ever told us something, it would be shredding at record highs carried serious risks. And I mean, on the upside, the fast storage narrative and positive news like NVIDIA's partnership with OpenAI or Oracle's TikTok data oversight continue to support US equities. And I mean, although tech stocks saw some of the performance divergence, I think they're still likely to have a good shot at climbing higher before year end, unless we hit a serious crisis in the next 3 months. And I mean, the logic behind is quite straightforward. Traders are betting there are likely still 2 more rate cuts by the end of the year, and that kind of liquidity expectations is the strongest tailwind.
Ecaterina, Mag 7 passé?
Well, I think at the moment it's still valid because I mentioned earlier we're still in the phase of build. So that the cornerstone of building that infrastructure, enabling the AI infrastructure, there is not just a momentum-driven support that the stocks have. The earnings have delivered for these companies. Now, of course, they deploy a significant amount of capex. 30%, almost 30% of S&P 500 of capex comes from this Magnificent Seven. They are again at the base of that build out of AI. Now, the narrative, or we call it the pyramid of AI, is narrowing and is focusing now increasingly to where the applications are, where the applications are going to be, who are the beneficiaries of those applications, and certainly in places like customer engagement, product design and innovation, design support, personalized experience, all of that across different sectors, whatever that's healthcare, financial services. So this is where the investors are tuning themselves into and understanding where this application is going to be and which are the companies that are going to be part of the next generation of that AI enabling and application.
And that's precisely it, right? Ecaterina, we talk about how the AI cycle is evolving, and it is evolving very rapidly. If you already played, the players for the early cycle, why not look at the alternatives that will drive the cycle in the future? So why stick with the Max 7?
Absolutely. No, and we have strategies that look at the future, and we are, again, Magnificent Seven need to be part of that future. They're part of the core. But as I say, they're becoming the core. And when you look at the growth and the momentum of that growth, or the magnitude of that growth, we need to find that those companies we need to identify. And again, this is an alpha opportunity. This is an opportunity for managers to distinguish themselves, to pick those winners into the next cycle. It's going to be harder because, again, it's quite a broad application. It could be a broad application. So we need to find those winners. But certainly having a team that looks and stays behind that will be basically the success story.
And Dilin, they say Apple and Tesla are no longer magnificent.
Well, I would say that's quite a bold call for me. Looking ahead, if Apple continues to innovate in hardware while expanding in services ecosystem, it can provide a steady upside still for me, for investors, and help tech indices maintain momentum. And also for Tesla, Tesla's EV delivered in Q3 came in slightly below expectations, yes. But the stock rally shows that the market is focusing on further growth potential, not just current numbers. And the real driver would be Tesla's AI investments and plans to launch humanoid robots in 2026. And this positions the company as a tech innovator and beyond, really into the auto sector. And from a market perspective, Tesla's strategy keeps investors excited about the broader EV and tech space, which can lift sentiment for related stocks and sectors for sure. So I would say Apple and Tesla both still count in the Magnificent Seven for me, and I would still be optimistic and look into their further innovations down the road.
So for you, Tesla and Apple still in vogue, and still in vogue, it seems, is gold. Some suggesting it could get to 4,000. What's your take on, this yellow metal?
Well, gold is just up and up. If you just give me a paper, for example, to ask me list all the bullish factors for me to buy gold, I can list maybe 6 to 7 reasons very easily. For example, central bank gold purchases, de-dollarization, Fed about to cut rates for 2 times by 25 basis points down, by the end of this year, etc. But on the right-hand side, if you are asking me to put down all the factors that can potentially be bullish factors for gold, maybe the only reason I can think about for now would be the long position is too stretched, and there are some, technical pressure from the upside. But in general, I think the least resistant path for gold is due to the upside.
And Ecaterina, of course, you say, forget gold, there's something more, there are other things which are more exciting. In about 20 seconds, could you tell us what?
Well, we've talked about it. The broadening of the AI story is there. We also need to increasingly investors in Asia are looking to Europe. Again, Europe has done immense shift into the fiscal stimulus, particularly Germany. They're changing the regulation. They're changing the framework and where investors can deploy a lot more capital. So again, there's themes that we do think the magnitude can be
We have to leave it there. Ecaterina, we have to leave it there. Ecaterina Bigos, AXA Investment, and Dilin Wu of Pepperstone Group, thank you so much for joining us today. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's cricket team won its 9th Asia Cup on Sunday in Dubai after topping rival Pakistan. There were no handshakes between the two sides ahead of the match, and at the end, the Indian squad skipped the traditional trophy and medal presentation led by the head of the Asian Cricket Council, who also happened to be Pakistan's Interior Minister. Let's bring in Bloomberg's government reporter, Sudhi Ranjan Sen. Sudhi, what was India's reasons for refusing to accept the trophy?
Well, it's a lot political, and a lot of that politics is also internal, because we've seen a bit of criticism of the government from the opposition parties for deciding to play Pakistan when there was a conflict between India and Pakistan not very far ago in May, when the two countries were literally at the edge of full-scale war with fighter jets, drones, and missiles flying. So this is a continuation of that 87, 88-hour conflict that the two sides saw in May into the cricket field. One could argue that the game of cricket is being politicized, but we've also seen Prime Minister Narendra Modi tweeting out, saying Operation Sindoor on the games field. Operation Sindoor is the name of the military operation that was launched after 26 people, mostly tourists, were gunned down in Indian-occupied Kashmir in Pahalgam. So he kind of tweeted after the game, saying Operation Sindoor on the games field. Outcome is the same. India wins. Congratulations to our cricketers. So that is the backdrop and the context to, not shaking hands or accepting the trophy from Pakistan.
So from the government level, government perspective, have they said anything about the incident?
Well, no, not really. I mean, we've seen the government saying that the operation, or the military operation, so to say, is still on, and the government is also, soon after the military conflict kind of came to a halt, we've seen statements from the government saying that this military operation continues. It's being kept in abeyance for the moment, and if there is another terror strike in India, India will continue with the military operation, basically indicating that it will not hesitate to take the military option to deal with any kind of attacks that it sees or perceives coming from Pakistan.
And Sudhi, meanwhile, Pakistan's leadership getting closer to Trump. We saw this. How is India viewing that?
Well, I mean, the Pakistan Prime Minister meeting President Trump, not really a major red flag for India, because it is a civilian leadership of Pakistan. But that said, where the shoe pinches for India is the deteriorating relationship with America, and in particular the trade deal, the negotiations of which are going on, but USA introducing new elements to it, which is the purchase of Russian crude into the trade deal, and also the tariffs. They introduced an additional 25% tariffs introduced because of the purchase of Russian crude. So net, the America relationship is slightly disturbed. And while that is there, the fact that the Pakistan leadership, both the military and the civilian leadership, has been able to cozy up to the United States is a cause of concern for India.
Sudhi, thank you so much for that. Bloomberg government reporter Sudhi Ranjan Sen coming to us from New Delhi. Let's get perspective, dig deeper. Rajiv Dogra, former Indian Consul General to Karachi, Pakistan, and author of Where Borders Bleed, an insider's account of Indo-Pak relations. Rajiv, good to have you with us. We heard from Sudhi there how, relations between the U.S. and Pakistan are going from strength to strength. Some say perhaps the best relations in decades. How is India viewing this relationship?
Well, India is viewing this relationship with best of luck to USA, because USA has had deceptions from Pakistan for the last 70 years, but it doesn't seem to learn from history. I think this particular phase of US-Pakistan relationship is more driven by Trump's greed for more contracts, because his son is busy signing away new contracts along with his friends, for example, for cryptocurrency setup in Pakistan, and for example, for rare earth minerals which have yet to be explored in Pakistan. Recently, we saw a photograph of the army dictator Munir presenting in White House a sort of a set of stones which he claimed to be rare minerals. Probably they were just bought during his trip from China. But that is it. That is how Pakistan operates. And that is how time after time again, USA gets trapped into believing Pakistan.
Is this also about military ties? You talk about Asim Munir, the army chief. It is his third visit to the U.S. He was seen in that photo with President Trump and Prime Minister Modi. He's been front and center. Is the relationship between the U.S. and Pakistan more about military as well?
Well, it's always been like that. You're absolutely right, because USA somehow finds comfort in dealing with dictators. Not just with Pakistan, but with many other countries. But with regard to Pakistan, it seems to have a particular fondness for dictators, military dictators in particular. Otherwise, there's no rational reason why the president of the largest superpower, largest democracy, in a sense, the oldest democracy in the world, should be hobnobbing with a military dictator. I mean, Munir, the General Munir, is virtually ruling Pakistan today. So his right counterpart is the military chief of USA. But instead, Trump is insisting on spreading the red carpet for him, not just once, but twice. And in the first instance in June, he hosted a lunch, exclusive lunch for General Munir for nearly about 2 hours. I don't know what they were discussing.
But Rajiv, some might argue that India isn't really playing ball either. We have Trump saying repeatedly that it would like India to stop buying oil from Russia. India has been pretty adamant about it, despite the fact that it started buying cheap Russian oil only 2 years ago.
Well, as you know very well, Trump is very selective in his judgment. Otherwise, he would not have applauded Erdogan of Turkey for buying much larger quantities of oil from Russia. He would have also ensured that Europe did not buy oil and gas from Russia, and Europe did not buy refined oil from India, which was originated in Russia. But much more than that, I think the larger question is the direction that Trump is taking USA to. It's no longer a democratic way of dealing with other sovereign countries. It is a sort of a diktat which Trump issues every morning. He gets out from his White House bed and decides that some country or the other must be punished. Unfortunately, India is his target, along with Brazil, for the reason that they are standing firm on their sovereignty issues and they are standing firm on their dignity, which is something that Trump is not familiar with.
In that trade agreement, we know that the U.S. has agreed to help develop Pakistan's untapped oil reserves. How significant is that? And how is India looking at it?
Well, the Pakistani people are themselves amused that USA has decided to discover and exploit oil reserves, which are supposed to be mythical, because Pakistan for the last 70 years has thought that it had reserves somewhere because it is an Islamic country. So since Gulf countries are rich in oil, Pakistan deserves to be rich in oil as well. But that, as I said, is a mythical assumption. There's no oil reserve in Pakistan, either onshore or offshore, as has been certified by various geological experts. So if Trump and his team of advisors and friends want to splurge their dollars, they are welcome, but they will not find any oil in Pakistan.
Rajiv, however you look at it, India is concerned because of the warming relations between the U.S. and Pakistan. What are the options open now for the Indian government, for Prime Minister Modi to perhaps get relations with the U.S. back on track?
Well, it is not for India to get anything back on track because India never went off track. It is USA which, for reasons of personal pique of Trump, decided to go off track. And the simple reason for that is Trump's obsession for the Nobel Peace Prize. So in that, he has imagined wars which never took place in various parts of the world. He has also sort of decided that he is the one who has stopped all wars in the world, whether he was involved in it or not. This included the 4-day war between India and Pakistan. India has insisted repeatedly and with solid evidence that India stopped and agreed to a ceasefire in that war because Pakistan approached it. Pakistan had been devastated by Indian bombing and Indian missile attacks. So then it came on the telephone line between the two Director Generals of Military Operations and requested that, please, we've had enough of a beating, please stop it. And India agreed to stop it. Trump had no role in it. Trump never telephoned anyone in India unless he dreamt up all this, which seems to be the case.
The thing is, Rajiv, it is a give-and-take situation. We have seen that Trump loves a good deal. He loves to negotiate. How far is India willing to go to ensure that relations with the U.S. get better from here?
Well, I've done a lot of research on Trump because I'm writing a new book on how nations decline or fail. And one of the principal causes is when the one person, one leader of a country refuses to see the other view. And in this case, Trump does not negotiate. I'm sorry to correct you, but Trump does not negotiate. He wants his will to be imposed on others. And that has been his way of operating in business all the way through his life. But what has been the result? Every single major business empire of his has failed, gone bankrupt. But he does not care. He does not look at them as bankruptcies. He looks at them as one more step into a new venture because bankruptcies and losses can be taken care of by the banks who unfortunately gave him the money.
Rajiv, there are other developments. When it comes to Pakistan, it's not just building that relationship with the U.S., it's also building a relationship, a closer one with the Middle East. Riyadh, in particular, Saudi Arabia, it signed a defense pact. What do you make of that development?
Well, the world should be worried because, as you know, there's a non-proliferation treaty, which means that you should not even dream of offering a nuclear umbrella. Now, the defense pact, there was always a defense pact between Saudi Arabia and Pakistan. That is all right. But the new mixture here is that Pakistan has promised nuclear umbrella, and its defense minister has gone on record on a recent television interview to say that our nuclear sets are available to Saudi Arabia. Now, can you dream or can you even think of such a possibility when a country, nuclear asset capable country, hawks its goods like in a shop, neighborhood shop, that, okay, if you want the big bomb or the small bomb, just tell us, give us the billions. So that is one part. And that is part for the course for Pakistan way of getting billions. But the bigger worry is the proliferation. Once upon a time, America would have ensured that this did not happen. But in this case, it seems America was in the know. Look at the contrast. Just yesterday, America has reimposed sanctions on Iran on various things because there is an apprehension that Iran may once again be processing its nuclear material to the bomb grade, whatever that is.
Right.
But here, ready-made bombs are being supplied by Pakistan and asserted on television by its ministers And yet the world is silent. One of these bombs could strike any part of the world and the effect would be worldwide.
Rajiv, as far as we know, the nuclear umbrella has not been extended. I mean, there's been no clarity whether it has or not. So I'm still quite unsure on that point. But in terms of the ripple effects for the region, how do you see this playing out? How might this play out?
Well, it sends out various messages. But just to sort of contradict you, I'm sorry to do that. But when Defense Minister of Pakistan goes on record on television, which was seen by millions of people, saying that our nuclear assets are available to Saudi Arabia, and that is what this defense agreement is about, then you do not doubt that. But as far as the ripple effect is concerned, I think a lot of countries would be very worried about this defense pact between Pakistan and Saudi Arabia, because it means that a war situation could escalate to uncontrollable levels.
Would you say that India has the most to lose in the closer relationship between Pakistan and Riyadh?
Well, I won't prejudge any such situation, but I think India-Saudi Arabia relationship stands on its own ground. Saudi Arabia knows that India is a reliable, serious and stable partner, and so does India. India regards Saudi Arabia as a traditional friend with linkages across various spectrum. So let's hope that nothing of the sort happens, and we wish Saudi Arabia well, as we wish Pakistani people well.
How about the outlook for India-Pakistan relations? Are you optimistic?
Well, as a diplomat or an ex-diplomat, I should be optimistic. I should see the glass half full. But as a realist, and especially as someone who's written extensively on Indian-Pakistan relations, especially the entire history of how Pakistan came about and where borders lead, which you pointed out very graciously, I think the current phase in India-Pakistan relations is particularly worrisome. And I say it for two reasons. Number one, Munir, the general of Pakistan Army, he, before the Pahalgam attack, where 26 innocent Indians were slaughtered by terrorists, he had, on a public forum, said that Hindus must be attacked. Now, how can anyone in a responsible position be capable of saying such things, which are, impossible even to think of? So when you have an army chief who is so visceral in his hatred of the other country, then there is reason to worry.
Rajiv, thank you so much for joining us today. Rajiv Dogra, former Indian Consul General to Karachi, Pakistan. India's been trading for about 3 minutes now. Let's do a check on the initial numbers. We have the Nifty Sensex in positive territory, but barely. They've been down for 6 days. The Nifty saw its first weekly dip in a month on Friday. Traders looking ahead to Wednesday's RBI decision. The central bank expected to hold rates at 5.5%. The Sensex currently about flat, and we have the Indian rupee trading at 88.70. And some say that when it comes to the markets, near term, expect markets to remain under pressure. Still ahead, Hong Kong's New World development under more pressure with the second straight year of losses. We take a close look at how the developers' troubles have become a cautionary tale for cities' tycoons and their heirs. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Hong Kong developer New World has posted a second straight year of losses as it continues to struggle from a weak property demand and debt pressures. Losses topped $2 billion, capping another challenging year, even as the firm tries to ease a cash crunch. Today's Big Take looks at New World's troubles and how it has become a cautionary tale for the city's other tycoons and their heirs. For more, let's bring in our conglomerates reporter, Shirley Chow. Shirley, what does New World struggle struggles say about Hong Kong's family-owned businesses? It is challenging.
Yes, so New World is a very typical family-owned business, and its leadership style is steeped in family hierarchy and filial respect. And business decision-making is sometimes influenced by the personal whim of family members. And New World has really become one of the most high-profile examples showing the challenges that this kind of leadership style can bring when the macroeconomic environment takes a turn for the worse. So New World expanded rapidly around 2017 and 2018, fueled by debt. And that came shortly before Hong Kong plunged into years of political turmoil and COVID isolation. And after COVID, Hong Kong's economy slowed down and its property prices crashed. And New World's debt problems started to show. So New World's challenges really raise an alarm bell for a lot of family-owned businesses in Hong Kong and across the world that share the similar kind of family-oriented leadership style and corporate culture.
Is there a way out for New World? We talk about liabilities in excess of 200 billion Hong Kong dollars. What does it need to do? Where does it go from here?
So New World's strategy right now is very clear. It will focus on selling residential properties for cash, and they will use the cash to pay down debt. And it's also trying to bring in outside investors to co-invest with the family. And it's also talking to banks to try to pledge more of its assets for loans. So right now, it's really focusing its strategy on generating cash and pay down debt. And, we'll wait and see whether this strategy will work. And if in 1 or 2 years, Hong Kong's property market improves, and I think that will help New World a lot as well.
And for these families, it's also about a new playbook, right? Because it is a different environment in Hong Kong than it was before when their parents were running the business.
Yes, so a lot of these family-owned businesses are now undergoing generational shifts, and that opens up opportunities for succession drama and family feud, and that could affect the management of their business groups. And at the same time, Beijing is really tightening its grip on Hong Kong's economy and politics. And that means these tycoon families are no longer as powerful as they used to be. And their business groups are no longer as dominant as they used to be. And at the same time, Hong Kong is seeing an economic slowdown and a property market crisis. And a lot of observers are saying that Hong Kong is undergoing some of the fundamental shifts that it has never seen during its previous economic cycles. And these tycoons' children haven't seen anything like this before. So these all add up to the challenges these families face right now.
Such a fascinating story. Shirley Chow in Hong Kong, thank you so much for that. Subscribers can read the full story on the terminal or on Bloomberg.com. NI Big Take is your function. That is it for Inside Horizons. Middle East and Africa is next. Do keep it here with us. This is Bloomberg.